Now, if you look at India, how it has changed in the last, few years and now, clearly we are a country where aspirations have clearly increased. A lot of companies have gone overseas to build these global aspirations. The whole focus has been on scale. And my view is that the next 3 or 4 years in India will be years where you'll see significant amount of M&A activity. If you look at what's driving M&A, number one, if you look at from the buyer's perspective, particularly international companies, they are actually having very low interest rates globally, so they can really borrow and invest into India. Also, the return ratios globally is relatively low, so they would like to get into countries where return ratios are high. So that's from a buyer perspective. From a seller's perspective, a lot of companies, particularly in the mid-cap space, we are seeing a transition from the first-generation entrepreneurs to the second-generation entrepreneurs. A lot of these second-generation entrepreneurs are not interested in running the businesses. They're finding it difficult to run businesses in tough conditions when you're seeing slowing growth. They are offering themselves up to M&A activity. You could see big-ticket M&As happening in the country of sizes you have never seen before. So I am expecting that there will be a big amount of M&A activity domestically in India, as well as Indian companies looking overseas. We are moving away from a regulatory-driven environment to a market-driven environment. And progressive, you will see regulations gradually coming down, and everybody fighting itself in the marketplace. Capital used to be very constrained, but more importantly, there's been a big asset liability mismatch in the bank's balance sheet. Banks are borrowing short-term, your deposits, your savings, and they're basically lending long-term. This cannot continue. We require long-term sources of money. So that's the reason they're opening up, the fixed income market. They're opening up FDI. They want all the sources of income, be it external commercial borrowings, whether it's FI money. They want all the long-term sources of capital because banks can't be running an asset liability mismatch for long. As far as politics is concerned, my view that historically it used to be very center-driven. Now it's clearly becoming dominated by states. A lot of people ask us what's going to happen to the elections. I think more important is what's going to happen to the states. The states are the ones who are going to be driving our GDP going forward, and there are some. It is said India is now becoming a country of chief ministers rather than prime ministers. So that is the way we would look at it going forward. Privatization, earlier they were looking at public offer of government stakes in public sector companies. Now, very quietly, they have gone through what I call the industry privatization, or you call it a backdoor privatization, where instead of privatizing state-owned entities, they started privatizing the industry. They opened up the telecom market to private sector, opening up the banking sector to the private sector, infrastructure sector, all, whether it's roads, power, airports, all opened up to the private sector. So despite these projects normally being, the domain of public sector, rather than going and having a private investor into a public sector company, they said, let the private sector come and privatize the industry. So that's the model they have used for privatization. As far as capital markets are concerned, we had a very narrow investment universe. I have a slide on this. Today we have about 179 companies of market cap more than $1 billion. And you'll see that a lot of these companies have been created, over the last 10 years. So number of companies which have become $1 billion market cap companies. What are the challenges we have? We are working on a very elite model. If you look at our agriculture, a percentage of GDP coming from agriculture, it's about 14-15%. But about 60% of our population depends on agriculture. So it's not a model which is, a model for mass inclusion. So the whole policy direction going forward will be mass participation in growth. We are very much a services-driven economy. Now this services component has gone up to 66% of economy, of GDP. We need to get the manufacturing act together. And manufacturing can only come if you're becoming competitive. Not because I want, manufacturing capacities to be set up. If land costs are going up, power costs are going up, how will manufacturing be competitive? So this is the direction they want to take, but it's going to be a tough transition. Physical infrastructure was the focus, but now they're also looking at social infrastructure, be it healthcare, be it education. Focus earlier was on agriculture. Now they're saying let's focus on rural GDP, where the services component of rural India is actually going up. Focus earlier was on growth. Now you have been noticing that a lot of focus is on growth, environment, as well as governance. So these are the three, areas in which they would like to grow. So it's not only growth for growth's sake, but you have to protect the environment and also make sure there's governance. As far as policy is concerned, there have been a lot of leakages in terms of social spend. They're now looking at the direct benefits transfer. This, in my opinion, is a very transformational project They're going to be implementing it for about 43 districts. India has got about 650 districts odd, where all welfare payments, subsidy payments, they want to directly give it to the beneficiaries. Today, for example, if you were to buy diesel, all of us benefit from the subsidy. But going forward, only those who are requiring the subsidy will be getting the subsidy. And it will be directly into their bank accounts. For those of you all who want to examine this model, please go to these sites to actually see how the entire model works. It's very, very impressive. They're doing a lot of work on this. In fact, they've thought well. It's a very well thought of project. It'll take about 3 or 4 years, to finally, get it implemented. But this is one of the biggest transformational projects that I see, which will structurally bring down India's, fiscal deficit. Earlier, our entire resources were given on allocation. Even today, it's all allocation. If you look at today, if you want to implement a road project or an airport project or a power project, it's all competitive bidding. But resources is all on allocation. Going forward, we are expecting that this will also be done through auctions. This is the inflation chart. You can see how inflation has moved. The good news is that now inflation has begun to moderate, and that's the reason I believe that it gives scope to the central bank to cut interest rates. You can see how the interest rate movements have been. There was a time when India was continuously increasing policy rates, and the reason for increasing policy rates was because our growth rates were very high. We increased it so much so that the growth rates came down. So now we have started to bring down the policy rates and the cash reserve ratios. Coming to the currency, and this is, in my opinion, the current account deficit is the biggest issue, much more than the fiscal deficit now. And the finance minister also admitted to it in his, budget speech. This is the reason why we cannot. Most of the foreign investors I speak to, they don't want to look at the India story unless they feel that there's stability of the rupee. Because whenever the rupee depreciates, they lose money on their foreign currency. So to that extent, if you look at in 2013, we're expecting a current account deficit of 4.5%. Now, very interestingly, if you see, gold imports in 2012 was about $56 billion. And the current account deficit is $78 billion. So a big component of our current account deficit is actually coming from gold imports. See, we have to import oil, we have to import commodities. So that is a given because we don't have these resources. But gold is discretionary. But yet people are buying a lot of gold. Went up from 34 to 56. In fact, because there was an expectation that import duty on gold was going to go up, there was preponement of gold imports. So our gold imports actually shot up because of that. Otherwise, we were projecting this number to be closer to the $37 billion. But knowing what happened in January and December before the import duty increased, we are now projecting about a $50 billion. So we have not really reduced our imports on gold for this year. Hopefully next year, you will see this number really coming down. So because we are running a deficit on the current account, we are completely dependent on the capital account. So whether it be foreign investment either coming through equity, foreign direct investment or portfolio investments, we are dependent on this. If this number is negative, means that we have a problem on our rupee. So we need to see a surplus. So if you have a surplus, then the rupee starts getting strength. Till then, we are completely slaves to what happens to the capital accounts. So the risk to the Indian story is, tomorrow, if the foreigners decide to pull out money in the country, then we have a problem. Because this entire number will turn more negative, and the rupee will depreciate, and you have a problem. Now, here I would like to talk about the foreign flows. If you look at the total FI money in equities which has come in the country, mark to market, is $225 billion. Our estimate is that out of this $225 billion, less than $20 billion is India-dedicated active long-only money. Okay, which is less than 10%. About close to $5 to $6 billion is India-dedicated ETF. Okay, that takes it to about $25 billion. About close to $75 to $80 billion is emerging market money, which includes emerging market ETFs and emerging market funds, which are allocating money to India as part of their overall country mix. And the balance is basically money coming from global funds, participatory notes into the Indian market. So really speaking, if you look at the last year, that is when India received $24 billion, and if you do the maths, you will see that last year, the long only India active money saw outflows. We didn't receive India dedicated money last year in active long only funds. There was a negative number. So all the money that has come into India last year has come because we have benefited from the allocations of global funds, emerging market ETFs, and the emerging market funds allocations. So this means that tomorrow, if there is a view that India is not a country to invest in, it is quite possible that ETF money or the allocations could basically go back. At least the passive money could go back. And that is a fear that we all have, that unless we get our story, back in shape, we have this fear of losing this money which has actually come in. Because the India dedicated money hasn't really come in. A lot of inquiries, a lot of discussions, but all are worried on the currency. So once you get stability in the currency, then the India, story starts emerging. And for us, capital flows is extremely important for the equity markets to do well.